Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. And today I'm joined with my good friend Phil Weiss. Hey, Phil.
Hey, Kirk. Happy Friday to you.
Yeah, happy Friday. You're better looking than Doug.
Thank you.
You're welcome, Doug. That one's for you, buddy. I'm just going to test to see if Doug's actually listening when he's not on the show. Doug had a last minute thing where he had a family thing, so Phil's filling in for him. So welcome to the show, Phil. Cool. Let's just dive right in. This is going to be fun. We named this episode "What Does Investing in Japan, Reddit, and the Moon have in common?" And I probably should have added Bitcoin in there too. And the answer is they're all going to the moon, right? They're all going there. Japan hit all time highs for the Nikkei. Bitcoin is, I think, they're 5 or 7% away. I'm not sure if it hit it today, but it seems like it's going to hit it any day. Let's see what it is today. I'm not sure if it hit all time highs. I think it was 60,000 or something like that. It hit.
It did hit 60.
Yeah, Reddit's going public, so most likely that's going to go to the moon. And we actually got to the moon again, right? It's been what, like 100 years since we've been to the moon, and a private company landed on the moon again. Awesome, that's good news. I'm sure they got their mining rigs in tow and ready.
Wasn't that rig sideways though when it landed? It could still take pictures, but that's what I saw.
Well, at least we got there. That's
Yes.
a start. Just think, if there was a human being on board, they might be able to like lift that up and right side it. But yeah, I have to say it was interesting that we've actually gone back to the moon, and I'm sure it's all economic. But I always found it to be puzzling. Why, after we got to the moon, why didn't we go back? Like, why did we just stop going to the moon? It was like, been there, done that. Yeah, let's go somewhere else. like why would we do that? It never made any sense.
It didn't. You're right. We had that big program, and all of a sudden, I guess they couldn't fund it. I don't know, but it just stopped.
Yeah, we beat the Russians, and that was good enough. We didn't. That's all we needed. We just needed to beat the Russians. It had nothing to do with the economics. We were just like, we don't care. We'll spend all our national GDP to go to the moon, and then we'll spend the next 30 years paying that off. Oh boy, good times, good times. Well, it is interesting times because we're starting to see a lot of areas like Japan, which has been 35 years. I think it's been 35 years since it peaked, and now it's exceeded the all-time highs, and yet still almost no one's talking about it. Imagine that. 35 years, and I'm sure people in Japan are celebrating, especially the government, which owns what, 92% of the ETFs. I mean, there's no market manipulation going there. Not at all. It's totally a free market. The government owns 92%, I think it is, of the Japan ETFs for the Nikkei. Like, all right, good luck with that. We'll see how that goes for you. Either way, it's at all-time highs, and kudos to Japan for finally getting out of the gutter. And what's funny, as we talked about it last week, is it oddly enough, when it broke out, is right when they announced that Japan's going into recession. Good time to celebrate recession. Keep pushing. We'll keep going higher. That's good for the stock market. It kind of reminds me of where we are here. It's like, oh well, we have interest rates which are holding pat at the current rate, which we haven't moved in quite some time, but the market thinks they're going to move in a few months, and the Fed's like, no, we're not. Market's like, yeah, you are. And they're like, no, not moving the rates. And I think it was the Cincinnati Fed. We talked about this last week. Cincinnati Fed came out like that morning and was like, yeah, we expect 5% inflation next quarter. I'm like, what? Like, and the market didn't react to that at all. And it's like, what is going on with the markets? I mean, what's your take, Phil? Like, what do you think? Like, why are the markets so crazy that they don't care about any economic data? Like, what's your opinion on this?
That's a really good question. I wish I had a great answer for you. I don't, but I will say a couple things on Japan. It takes away one of my lines when I say when we invest, we assume everything's going up unless you're Japan. But now Japan has passed its old high, so we can't say that anymore. But it's a very different market than the US, because I was reading that Japan, the value stocks are what's driving it, while here it's growth. So it's a very different thing to look at. As far as our market, I was reading something earlier that talked about the fact that this could be a repeat of what we saw in the 90s. If you think about the growth that we had, and we have this explosion in growth driven by the internet, could we be experiencing a repeat because of AI? And so what we saw in the 90s was that the market went up and inflation was benign, everything was good until it stopped, and then it went, then we had 2000, and there was all the hubbub that was around the going to the new century and everything like that. And I remember the Y2K issues, but it's possible, at least if you look at the data, that we could be experiencing a repeat of what we saw back then. But why the market keeps ignoring, I don't know. I mean, it's not like before we always said there's not another alternative, right? Because interest rates were so low, but now interest rates are reasonable. You can do okay putting money into treasuries. You can get 4 or 5% depending upon how long you go out for. That's a lot better than we had for many years. So it doesn't totally make sense to me that the market just seems to keep ignoring, say, no, Fed, you're going to raise rates. I mean, lower rates. It doesn't make sense.
And what's funny is they've been saying that since Powell said we're going to start raising rates. This is back in 2021. Was it 21? Yeah, 21, because 22 was the bad year. So in 21, Powell had communicated to the market we're going to start raising rates in January of, I think it was 22 is when they first started. But he communicated that very clearly 6 months ahead of time. Here's what we're going to do. The market knew, they're all prepared. And we were at all-time highs at the end of 21. And it was like, what is going on? And I was wondering to myself, like, why the heck is the market not selling off? Like, I don't get this. They clearly know that in like 15 days, they're going to start raising rates, and the market just doesn't care. We're at all-time highs. It's like, what is going on? And then January 2nd, oh, now I know what's going on. They were waiting till January 2nd to sell everything. And then it just turned into a disaster of a market for that year. Everything went down. Stocks, bonds, baseball cards, whatever it was, everything went down that year. And then 23, everything looked rosy. And yet here we are. Rates are still like 5.25%, 5.5%. We're still up there. And the Fed has given an inkling of, yeah, we may lower rates at some point, but we're also data dependent. And right now the data is showing they're not going anywhere. So it's this constant question. And I bring this up mainly just so the listeners can understand how the markets work, right? And how they don't work. Because if you were logical in terms of, if you were actually, they talk about like efficient market theory, and everything's efficient, and all the information's known by everybody, and so there's really no there's no information that is going to change the market because nobody knows it, and that's just totally untrue, right? It's totally untrue. And here's a good example: everyone knows the information, they're not pricing it in. So 2021, the market knew the information. There was no surprise in January 2nd that came out. The market just decided, all right, now we're going to sell everything off because of effectively window dressing. All they want to do is, hey, we want to squeeze out the returns, and then we're going to sell everything in 21 because, hey, now it matters. Well, everyone thought the same thing, and then bad stuff starts to happen, right? Or look at cryptocurrencies. The end of 22, it was a recent really bear market low. It was like down 70% or something, and then last year, we didn't hit all-time highs, but it went through the roof. Well, it was more of a calendar. It was more of a coincidence of the calendar of where that fell, and sometimes that happens. But it does make you wonder if you have an obvious macro factor out there, like relatively high interest rates, and I don't actually think they're high. Historically, they're actually even a little bit below average historically, but compared to the last 20 years, they're actually really high because we've had 0% rates for the last 20 years. And the reason this matters is because interest rates drive everything. Because if you have 0% interest rates, as Phil said, everyone called it TINA. There is no alternative, right? It's equities or bust, because you can't invest in debt because debt's paying zero. So why would you take that risk? It's really high risk. As a lot of people found out in 2022, when you have the 30-year treasuries losing close to 50%. I think it was like 44% or 43%, but it's close to 50%. Your quote unquote safe bonds, your treasuries, quote unquote safe bonds that people think are guaranteed, which I guess if guaranteed, if you compare that to the government paying you, sure, I think that's a high probability of being correct. But it doesn't mean you're not going to lose money in that 30 years, as we saw in 22 when your treasuries go down 40 some odd percent. That's not great if you're running a portfolio. Now, if you own the bonds, whatever. But if you own a mutual fund, you're in trouble. And so the problem is that you look at the data and you say, well, the data suggests that the market should be a lot lower because high interest rates affect the impact the market. They slow growth. It's harder to borrow. It impacts cash flow. All of the stuff that matters in a business. And the fact that we had 0% rates for like close to 20 years means that everyone was accustomed to that. Now we have this new paradigm that no one is used to. And this may be part of the answer, is that people are so accustomed to interest rates being at zero, they naturally think, we had a speed bump. They'll put it back at zero. We don't really care. We're just going to ignore the Fed because the Fed's irrelevant. Yeah, it doesn't matter till it matters, right? It'll matter when people actually step up and they're like, oh, I can't make my payroll this month. What do I do? Or I need to, here's another one. Like, if you have commercial real estate, for example, and your debt's rolling over in the next year, you're in trouble. Like you're used to like 3%, 4%, whatever it was, and now you got like 7 or 8%. For many people, that's the ball game. That's when you hand back your keys and say, sorry, we're done. Yeah, there's nothing I can do here. And so a lot of commercial real estate people that I know are buying down their debt. They're paying it down with cash flow. They're just paying it down as quickly as they can to lower their risk because they know they're in trouble. There's nothing they can do. And it's a real problem. We shared the chart last week of the cash flows, but I think one of the things that we have to realize is that just because the market doesn't see it as a problem, at some point it will. For example, it might be, and this is March 1st and is not showing up this way, but it could be that the market decides on March 1st, oh, we're just going to sell off the market, or we don't care. And like right now, the S&P's up like almost 1% for apparently no reason whatsoever. But sometimes the reasons have actually nothing to do with fundamental reality. Sometimes they don't. And you need to be comfortable with that. So if you own bonds, right, you own a 5% treasury, you're getting 5% a year for virtually guaranteed. I can't really use that word. That's why I'm saying it's virtually guaranteed. But as long as the government's going to pay, which at this point in 30 days, 90 days, they're going to pay. 30 years from now, I'm not sure I'd take that bet. But, the next 90 days, I'm pretty sure they're going to pay. So as long as they're going to do that, I'm assured to get my 5% interest. Or I could roll the dice with the rest of the market and say, hey, let's hope stocks keep going up, even though they're really overpriced. This is a public service announcement. Have you ever played the lottery? My state advertises that you can't win if you don't play. What they don't tell you is that the lottery is a tax on people who are bad at math. How many lottery winners have you met? Probably none. If you don't like your chances of winning the state lottery, you're definitely not going to like the chances of winning the inflationary lottery. The inflationary lottery? That's right. Your chances to win the state lottery might be 1 million to 1. But you're guaranteed to win the inflation lottery because it affects everyone. And the prizes stink. But here's what you're going to win. Higher prices at the store, shrinkflation in your packaged goods. Higher heating prices to heat your home. Who doesn't want to win that lottery? Much like the government, I feel bad that your costs are rising. So I want to help you out by giving you some free money. It's not a lot. It's only 1 million Zim dollars, but it's something. Well, you can't buy anything with it, but it does look good as wallpaper. And if you live in Europe, you might even be able to use it to heat your home this winter. If the lottery is a tax on people who are bad at math, then inflation is a tax on people who are bad at economics. I want my listeners to be better at economics. So I'm giving my loyal listeners free money. Go to www.moneytreepodcast.com/free money. Follow the instructions to get your free money today. I have a large audience and a limited number of these currencies. So let's make sure we get yours before we run out. Go to www.moneytreepodcast.com/free money. Follow the instructions and get your free money today. So Phil shared an image with me, and I want you to talk to it, Phil, because I thought this is something we mentioned on a prior show about comparing NVIDIA to Cisco. So Phil, you want to talk about this?
I'm sure, happy to.
All right, here we go. I'm sharing the screen here for all you listeners. You can just pretend like you're seeing this. Go ahead, Phil.
So if you look at this chart, the red line is Cisco and the blue line is NVIDIA. And we had the 90s. And I mentioned before the fact that some people are thinking it could be the roaring 90s. Well, in the 90s, we had Y2K, the internet bubble, all these things going on. And Cisco stock went through the roof. And that's what you see there. And then a lot of issues came out about what was going on with Cisco, and the price fell, and it's never gotten back to that level. If you look at the blue, although there's a longer, you can't see it very well because it's over the black line. So there's a longer period where it was flat. But if you look when NVIDIA starts to go up, it looked a lot like what you saw with Cisco. It's almost a vertical chart. So it's very similar. Doesn't mean that we have to see the same thing again, but they always say that history doesn't repeat itself, but it often rhymes. And this has that kind of feeling. And I was talking to Kirk before we started too. Back in that period of time with Cisco, I was writing for the Motley Fool, and I was one of the analysts that they had. And I covered Cisco for the Fool. And I had a really good relationship with the woman that was in charge of IR at the time. And when I wrote my research, I spent a lot of time with her, talking to her about the company, making sure I understood everything. And then the stories came out about the fact that one of the things that inflated Cisco's business results was that they had these vendor financing deals. So they basically financed these purchases, and then they didn't get paid for them. And they ended up writing off a lot of inventory, and a lot of other accounting shenanigans happened. And I wrote about that too. And the woman that I had talked to was no longer with Cisco. But I'll tell you that after this happened, when I reached out to Cisco to talk to them, I got the silent treatment. They wouldn't talk to me anymore because I had written a true story about what had really happened, but it wasn't favorable to the company, and they didn't like that I shared it. So all of a sudden I was now persona non grata with Cisco.
That'll teach you, Phil. That'll teach you to be honest. There you go. There's a story straight from Phil. I read this great book called Fullable back in, I think it was 2002, 2003, and at the time the guy was like one of the foremost institutional researchers. Like he had won awards, and I forget the guy's name offhand, but he had won a lot of awards and a lot of respect from his peers. And he basically illustrated exactly the game that Phil's talking about. Like you cannot say negative things about the company because the investment bank that the researchers work for want the investment banking business. So if you're supporting like Apple or Microsoft or whatever, you pick your stock. I'm not picking on anyone. And then you say something bad like, oh, like they're going to have poor numbers because of this. You're not going to get their investment banking business that they're out there, pushing around. And so you're as Phil said, you're persona non grata. That's a problem, and then you can't get to the table anymore, which means you're pretty much done as an analyst because no one will talk to you. So I think it was Michael Milk, or I forget the guy's name. I feel like his last name was Milk, but
Was it Milken?
Not Milken. No, not Michael
Okay.
Milken.
Michael Milk. Yeah, I remember who. Yes,
yeah,
I
he was like
remember
a finance. He was doing the finance sector and the banking sector, and he was notoriously sharp. Like everyone knew, like if this guy said something, you followed it because it tended to be right. And at one point, he just got blackballed by everyone, and he had to go out on his own. And then it's hard to, I'm sure he did fine on his own, but like you stopped hearing from him because companies just wouldn't talk to him. So anyone here who is reading research from an investment bank or a brokerage house and you think it's accurate, are you the same person that's watching the news and thinks that they're telling you the truth? Because that's really what it is. It's the same game. The news is basically propaganda. People have known about this for a while on both sides. I know for those of you who are listening to Fox, you're like, no, Fox is correct. And those who listen to you in MSNBC, you're like, no, MSNBC is right. They're both wrong. It's all propaganda. There are no incentives for them to tell you the truth. And it's the same thing on Wall Street. And I say this because the framework overlays for most things in our life. Politicians, you've got the news, you've got corporate America, you've got all these areas where people are lying to you because they have to, because the incentives are lined up for them to lie to you. So you have to do your own research. This is why we talk about this in the show all the time. Do your own research. Don't get lazy and buy into somebody else's research. Now, if somebody's independent and truly independent, and there are very few people out there, they do exist, but there are very few people out there doing that. We actually have had a few in the show, but you really have to find somebody who's independent of a big firm with other biases or incentives. If you can find one, those people are worth gold. And they're hard to find, but they are out there. We actually had one on. I interviewed a guy, Doomberg, this week. The guy's brilliant. He has a great team. There's a few people out there, but if you really kind of like, and I hate to bring this up, but I was listening to a good podcast. I think it was Lex Friedman's podcast, or interviewing Tucker Carlson, and he was just talking about, because they're kind of polar opposites in the political spectrum in a way. But he was talking about his Putin interview, and it was just interesting to hear his perspective on the media and like how information is conveyed. And so there were a lot of isn't that interesting moments on that podcast, which is why I liked it. I don't really care what he said, but there were a lot of moments there you're like, well, actually this overlay is very similar to what I think about this. So I thought that interview was great. Whether you like Tucker or hate him, I don't really care. But I thought the interview was really interesting because, I mean, who else has interviewed Putin? So you give the guy credit for even trying to do that. I know I have this in our disclaimer on the show, but realistically, it's interesting to go out and interview people that you quote unquote shouldn't interview, because the reality is that who says you shouldn't do these things, right? I mean, we interview people on the show all the time. We're always looking for really smart people who have a different perspective, many perspectives we don't agree with. And some of the listeners will probably get it from the panel. Sometimes we'll interview people that I totally don't agree with, and I think they're nuts. But you know what? That's why we bring them on the show, to talk about it. It's not a gotcha interview. It's not a I'm smarter than them. It's just, hey, here's a guy or gal with an interesting opinion. Let's hear it. Like, talk about it. And if I think somebody's totally full of it and they're just like, I mean, you talk about like the ESG movements, like greenwashing. I'm not bringing somebody on to do that. Like, once in a while I will, just to kind of show the listeners that, hey, this is what it is, and we'll try to point out like, well, you can see for yourself that this is maybe a little bit more, let's just say, more intellectually dishonest on their part. But if somebody truly believes in something, let's come on the show, explain it. Like, I want to hear your views. I want to talk it through and understand where your thinking comes from. Even though we don't believe in the MMT concept, I'm trying to get somebody from MMT to come and talk about it, because I want to hear their views. I want to go back and forth. So we're always looking to do that, because I think that's how, as a podcast, one of the best things that we can do is long form content that we get to the heart of the matter. We interview people about a concept, and the listeners can make up their own mind. My job here is not to, I mean, obviously I have an opinion, and a lot of people here listen to me for my opinion, but my job here is really to educate and inform and help you become better thinkers, not to parrot what I'm saying, because as you probably know from listening to the show, I don't give a lot of my real opinions. I'm just giving opinions to help you think about issues, and I try to keep my opinions somewhat to myself, just because I don't want to pollute the the investosphere with another opinion, because opinions, everyone's got opinions. It doesn't mean they're right. But if I can teach you to think better, if I could teach you some mental models and frameworks of how to think about things, that to me is success. That makes me happy that I've influenced somebody to have a better mental model, so they can think about the world and not get sucked into this garbage that everyone's parroting out there. So that's really the goal of the podcast, and we want to do more and more of that. We got some stuff we're coming up with this year that we're going to do more of that, so I'm excited to bring that out. But I know, Phil, you got to probably wrap it up here in a few minutes. So what are some final thoughts from you?
So I'd just like to follow up with two things with what you just said. First of all, I love that there's people that you bring on with different points of view, because I always think about confirmation bias, which is one of the biggest biases that gets in our way as investors. And that's that we only want to find people that have our opinion. And it's also affected the political arena too, with all the social media. People can easily find people that have their opinion, and then all they read is people that share their opinion, and they never understand the other side. And if you don't understand the other side, it's really hard to be a good investor, because you don't know how, you want to know what can go wrong. And then I want to go back to the story too for a second about Cisco, because I'll give you another example. And this one's quite interesting. So later on, I became an energy analyst, and I covered one of the companies I covered was called Chesapeake Energy. Chesapeake was run by Aubrey McClendon, who unfortunately they believe he committed suicide a few years ago because of all the problems that the company had. But while I was covering Cisco, I found a lot of accounting irregularities. They did some deep forensic accounting, and I had a number of issues. And when I was an analyst, I used to get called by media people all the time. And in particular, there was a couple people from Reuters that I talked to a lot. And Reuters was actually the person I spoke to the most. Chesapeake actually told her, stop talking to Phil. Find somebody else to talk to that has a better view of our company. And it ended up that I was one of the big sources that they had for a story they did about all these accounting issues that Chesapeake had. They were selling these long dated futures. I remember they said, we can forecast oil and natural gas prices better than anybody else. Nobody can make that statement. Then they also they would, instead of doing loans, they had this situation where they would sell future production of oil or natural gas, mostly natural gas, because that's what their business was. And they get paid for it up front, and then they'd have to pay it back by future volumes. And I said, I don't care what you're paying with, that's a loan. And they said, oh, no, it's not. But all these things that they did, and they went into these joint ventures where they got all this money up front. And when natural gas prices started to collapse, they still had to spend all this money. So because that's how they got paid. So they made all these bad decisions, and they were all very short-sighted. They also said that they could forecast the weather better than anybody else too, because they had all these experts.
Didn't Enron say that too?
Yeah. And what ended up happening at Chesapeake, after Aubrey left the company, they went Chapter 11. They're back now, but those things come to risk. You have to do your own research. That's such an important point. You really need to do your own research, because a lot of times the analysts that cover companies, they're incentivized to say nice things because they get something from the company for doing that, and they get access. So you're not always going to get the straight answer. It's better if you do your own.
Yeah, it's really, and I want to share one more chart here before Phil has to run here. So I want to share this chart because I thought it was really interesting. And this is a chart of the Dow Jones Industrial Average, pretty much from a little bit before January of 21 up until close, not today, but maybe a week or two ago. It compares the Dow Jones Industrial Average, the DIA ETF, ExxonMobil, XOM, and Salesforce, CRM. And what the reason for showing this is that I believe it's my understanding that Salesforce replaced ExxonMobil as a Dow stock. And for those of you who don't know, the Dow 30, there are 30 stocks in the Dow Jones Industrial Average, and they change them based on a variety of factors. And so throughout the years, there are different changes that are made. So I won't run through them all. I'll put them in the show notes. They're easy to find online. But basically, you have an energy company that was replaced by a tech company. Now, how many energy companies do we have in there now? Zero? Chevron. Sorry, you have
Chevron's
Chevron.
still in there.
Chevron's still in there. But I think the ESG movement kind of bumped ExxonMobil out. And, people are trying to get rid of carbon, even though they're not really getting rid of carbon. But makes them feel better by saying they are. And so what happened? Well, Salesforce in the last few years is only up 5%. The Dow's up 40, almost 45. Oh, ExxonMobil's up 203%. So it always makes me scratch my head, because ExxonMobil's one of the largest, if not the largest, oil and gas company. Are they still the largest, Phil? Or are they?
I believe they still are, yes.
Yeah, so they're the largest above Chevron, and yet they're not in the Dow 30. That should make you scratch your head. So pretty much when you're thinking of a lot of the constructs of buying indexes or indices, one of the challenges is what's in there. So as Phil said, if you try and do your own research and you're just buying an index, you say, well, I'm not smart enough to do the research. That's probably accurate for 90, 95% of the people. It's not that you're not smart enough, but you're not interested enough. You don't have the background. It's really not your intellect. It's more of just your experience and understanding of it. Most people can't do that kind of research. I mean, Phil's pretty sharp at this, but most people don't have the interest or the time. So most people will just index. They'll just buy an index and just make it easy. The problem is when the index takes up 33% of the made up of 5 stocks, I think it was, let's see, I'm trying to bring up the chart here. Somebody had shared this with me and I thought it was hilarious. Let me see if I can find this. There's a handful of companies that make up most. Oh, here it is. Here's the chart. So if you compare, here it is. Okay. So if you compare the U.S. stock market on a comparison to all other stock markets, it dwarfs everything else. The closest thing, China, is close to 35% or 40% of the U.S., so like 60% less. The seven biggest U.S. stocks are half of the Chinese stock market, little less than half. It's more than it's close to or equal to the Japanese stock market, I guess, since it's going up mainly. But with exception of Japan and China, the seven biggest U.S. stocks dwarf every other stock market on the planet. Now that should make you scratch your head, because is big tech the best thing is going forward? Is big tech going to grow at the same exponential rate that they've been growing? Maybe. I don't know. Maybe it is the next path, but it smells a little bit about like the late 90s when this time is different and tech's going to go to the moon and nothing else matters. Hmm. Makes you think a little bit, doesn't it? Like maybe big tech's gotten ahead of itself, which actually is showing in the price because the stock market has been going up and big tech has actually been lagging for the most part. It's been driving the market for the last like 15 years, more or less. And now it's not. So it's interesting. We could be having a rotation where other stocks are picking up the slack and big tech's going to take a break. That's very possible. But you should just be aware that big tech is a huge portion of the U.S. stock market. Um, like I think seven stocks are like 20 to 30%. I forget what it is today, but they're a big portion. And so if they're lagging, that's going to drag on the index performance. So the big question you should ask yourself is, how should I be investing in a time where a lot of stocks are overpriced, real estate's overpriced, bonds are actually a reasonable bet right now, depending on which kind of bond you want. The governments are the U.S. Treasuries, but you should really think about like where is your best risk to reward outcome. In my opinion, it's short-term government bonds are the best risk reward. It doesn't mean that the stock market's not going to do better. It just means compared to the risk you're taking, the reward is not commensurate, in my opinion. Now, there are a lot of people who are investing in equities and they're just going to go all in. Good luck to you. Teach their own. But if you really want to manage risk, and I want to leave one point and then give it back to Phil to wrap it up. I saw this survey by InSpearX. I think I don't know who the heck they are, but I saw this. The survey, and I thought it was interesting. Here are two things that stuck out. So they're doing a survey. They surveyed advisors and they surveyed clients. And generally, if you look at the different categories, like what do you think are the most important or the biggest concerns? Advisor clients were generally lined up, except for one category: stock market correction. So they were looking at geopolitics, market volatility, inflation, recession, rising interest rates, rising taxes, U.S. political divide, and then stock market correction. Clients had that number two as top priority. They didn't want this. Advisors, it was last. Advisors had the lowest opinion of a stock market correction and the least amount of care out of that. I also want to point out that there's also, if you look at advisors, that approximately 66% of advisors embrace the benefits of individual and bonds instead of bond funds for their clients. And those of you who don't know the difference and you have an advisor who just puts you in a bond fund, come talk to me, because it's probably not the best thing to do at the moment. But it just points out, I thought it was a good survey because it just kind of points out that generally advisors aren't worried about it because their opinion is you should just buy and hold. Don't worry about it. You just ride it out. Well, if you become Japan and you're 35 years later before you hit the stock market peak again, you're in trouble. So just keep that in mind with your investing. I personally wouldn't be taking a lot of risk here. It doesn't mean you can't take risk. I'm not saying stay all in cash and hide under your mattress. That's not what I'm saying. I'm saying just be mindful of the risk you're taking. If you don't understand the risk you're taking, find someone who will assess the risk. And we do free risk assessments for people because most people just don't know, and we just want to point it out. And we do it on the show here too. So if you're interested, let us know. We're happy to do it. But just assess the risk you're taking. It doesn't mean you shouldn't take risk. Risk can be a good thing if it's assessed properly. But if you don't know the risk you're taking, then you wind up like 2022, where the 60-40 portfolios and everything else goes down like 30-40%. You're like, what happened? Like, yeah, I thought my bonds were supposed to protect me, and of course they didn't. So that's kind of where our head's at. And we'll talk more about this in the next few weeks, because I do get a sense that the markets are a little bit wishy-washy here, and I think it's a good time to assess where you are and make sure that you're in a good place before you move forward. So, Phil, you want to final thoughts and wrap it up here?
Sure. Thanks, Kirk. So I just want to go back for 1 second to what you were talking about with the Dow. Best example ever is they took IBM out for 40 years and then they put it back. And if IBM had been in the Dow that whole time, it would be much higher than it is. And we just added Amazon and they took out Walgreens. Historically, the stocks that come out outperform, just like you saw with Exxon and Salesforce. The stocks that come out outperform those that stay in, or they come in. So just because, so that it also means don't go out and buy Amazon just because it got added. You have to have other reasons to buy it. Don't just say, oh, it's in the Dow now, that means it's a good buy. It doesn't mean anything at all. As for me, I know that experiencing big life transitions can be stressful. And my job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. You can download my free ebook, How to Flourish Through Life's Big Changes, at apprisewealth.com/ebook. And you can also sign up for my blog. Thanks for having me today, Kirk. Appreciate it.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.